The FOMC remain on hold at their March meeting, but forecast changes point to growing unease over the trajectory of demand, while inflation remains a pacing threat. The FOMC's median GDP forecast for 2025 was marked down from 2.1% to 1.7% in March, taking their growth expectation from well above trend to below. While the median forecast for 2026 and 2027 are little changed, the full range of participants' forecasts imply that the downside risk being priced for 2025 could endure, with the low end of the growth range for 2026 also halved from 1.4% to 0.6% in March. We certainly believe that the FOMC should remain cautious on growth. Given the marked deterioration in consumer demand in January and the further sharp fall in consumer confidence in February and March, we currently project below-trend growth for the US of 1.5% in both 2025 and 2026. Bear in mind, this is before the risks associated with large-scale tariffs and immigration changes are observable. While the market's focus has been on consumers' loss of appetite, arguably it is the persistent weakness in US investment that holds greater significance for the outlook. For all the fanfare surrounding the IRA and CHIPS Acts, equipment investment has not kept pace with the rate of economic depreciation over the past 4 years, averaging annual growth of just 3.2% after an even weaker run before and during the pandemic. Structures investment was stronger during the last presidential term, averaging growth of 4.6%, but the average annual rate of growth over the decade is extremely weak at just 1%. The effective erosion of the capital stock is not just an issue for the US's long-term growth potential, it also has a bearing on inflation. Capacity constrained, a growing population is likely to bid up the price of essentials, from housing to health to energy. This is why we expect annual inflation to remain materially above target, even as growth slows below trend and the bulk of the tariff effect fades, with annual inflation around 2.5% in 2026 on our forecasts, compared to the FOMC's 2.2%, following a 2.8% increase in prices in 2025. The unchanged Fed funds rate projection from December, including 50 basis points of cuts forecast by end 2025, another 50 basis points in 2026, and one more cut come 2027, points to the FOMC currently being of the view that the changes in their risk assessment are offsetting and heightened uncertainty transitory overall. We instead believe the downside risks of growth and upside risks to inflation are set to endure. As such, we anticipate the FOMC will have to, likely uncomfortably, pause policy easing indefinitely after only 2 more cuts at a contractionary 3.875%, so as to hold back demand and slowly abate inflation pressures towards target. A higher for longer policy rate and persistence in inflation argues for fiscal risk increasingly being priced into government yields during 2025. For around 4.25% today, we see the US 10-year yield rising back to 4.7% at year-end and slowly drifting higher again in 2026 and 2027, as tax cuts are delivered and meaningful reductions in spending remain an ambition. Intriguingly, this setup points to US domestic financial conditions continuing to tighten into the medium term, capping the US's upside growth potential and leaving the economy susceptible to downside risks. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.